Welcome back to the Home Path Podcast. This is Rafael, and today we're going to talk about the credit score myth, how to buy a home with less than perfect credit. So if you looked at your credit score before and you think it's holding you back, that's part of the equation because it's not just how you pay your obligations or what's on your credit report. It's also how much money you bring in versus the debt that you carry. Because at the end of the day, when you are getting a mortgage, the thing that the underwriters, the systems, and everything wants to figure out is what is your ability to repay. That's all the algorithm is trying to figure out is your ability to repay and which signs do you show. And it's not just if you have a really good credit score. If you have an 800 FICO score, that's great, but it doesn't mean that you can afford a mortgage because maybe you don't have a job. Maybe you're paying your bills on time, but there's a lot of different factors that will play into can you pay back the mortgage or the debt that you're taking out. So credit score is a myth because it doesn't mean that you can't buy a home. And sometimes if you have a lower credit score, yes, it could implicate that you may get a higher interest rate. But that's only one factor of it. It's a myth that you can't do it. There's tons of lending institutions that have figured out algorithms and figured out ways to prove that you have the ability to pay with something called compensating factors. And these compensating factors could be maybe you're going to put down 10% on the down payment because you have a 500 FICO score. Can you do this? Yes, you can. There is FHA programs with lower FICO scores, but you have to show compensating factors. So there's got to be something else that you got to show to say, look, I know the credit score is rather low, but not only do I have a steady job, but I also am putting down a stronger down payment in order to make this happen. And the same thing happens whether it's a VA loan or different type of programs. There's a lot of lending institutions. It's not just like the old days where you used to walk into your local bank, whoever you bank with, and try to get a loan because they only like to give out loans to people with really good credit. There's a lot of great lending institutions out there, and that's one of the reasons why I love being a broker, is that I'm able to work with lots of different banks all over the country or lending institutions who specialize in different programs, whether it's for self-employed, for those that have lower credit scores, for those that want to buy a home that's in rural areas. There's so many different programs out there that it's not just about the credit score. And most of the time, when we're looking at your credit score, we're looking at the credit report because just because you can, just read off your credit score is the end result. You have to understand how credit reports work or the algorithm, because that's the question that I had to ask myself back in like 2007, because I didn't even know how credit reports worked. I had to learn all of this. I had to go down the rabbit hole and say, okay, there's algorithm in math that once you plug in a credit card or a car loan or installment loan or a balance on a credit card, all of this factors out at the end of the day a credit score. So it doesn't really tell me a lot. I need to look at the type of account. I need to look at the balance. When did you take it out? How many inquiries do you have on the credit report? Because inquiries also tell a different story. So a lot of times when you go and ask someone to borrow money, one of the things that you'll do is you'll go and ask someone to borrow money, but they don't know how many other people you went to that same day to ask to borrow money. So the credit report, they like to do that. When you go get a car loan and you go to those car dealers where they're going to pull it through like 15, 60 banks, then you're going to end up with all those inquiries on your credit report. And by the way, on average, inquiries can decrease your credit report by average of 3 to 5 points per inquiry. So it can really kill your credit score if you just let someone do that. And I know a lot of the times you get swindled, you go into those car dealerships and then they tell you they can get a better rate, and then they run through every lender under the sun, and then now you have like 60 inquiries. I've seen it all the time. And unfortunately, it impacts your credit score because it lets everybody know how many times you've tried to apply for credit, and it makes you look needy, it makes you look bad. So it's not good to have a lot of inquiries on your credit report. So when you're reading your credit report, and if you haven't looked at your credit report recently, take a look at it. And some people will say, I don't really want to do that. It's pretty bad. You have to face it. You have to look at your credit report and you have to know what's on there, because most people just don't know what's on there, and they need to know what's on the credit report. So then the next thing you have to do is, once you look at your credit report, you have to look at what's the biggest factor that's impacting it. Is it that you have a lot of collections? Is it that you have a lot of inquiries? Is it that you have a lot of debt? Because you could always do something to your credit report right away. Even if you just have a lot of negative stuff, one of the best things that you can do right now is to add positive payment history. And if you have bad credit and no one's going to give you a credit card because you have bad credit or you have collections, one of the best things you can do is just get a secure credit card either from your bank or somewhere else that is going to report that credit card to all three credit bureaus. There's tons of companies out there. I think Sky is one of them. First Progress is another good one that reports to all three. So a secure credit card is a credit card that you are financing yourself. So you're saying, hey, here's $500, and now your limit is $500, and now you can use it for gas and food, and then make payments towards it because you're using the card. And then from there, they're going to be able to report that to the credit bureaus and saying you're paying on time. So what you're doing here, this strategy is that you're offsetting your negative history by adding positive payment history. And it's good to maybe get 2 secure credit cards while you're still working on lowering the balances on your credit cards, because a lot of times it's just that your credit cards are maxed out. So you have to say, okay, look, if you're at a 9 to 5 making the same amount, you're going to have to sacrifice a little bit of sleep and get yourself a little bit of side money, side hustle, whatever it is you want to call it, but at least to start attacking some of those credit cards and say, okay, here's the big bold number of how much I owe and how do I need to bring those down. And the next question that I get asked is, well, how much do I need to bring down the balances by? And the answer is, you need to at least keep them below 30%, at least to see a good boost in your FICO score. Is because remember, all of this is algorithm and math plugged in, because all it's trying to figure out is, in the future, how likely are you to default on all of your cards. So if you're maxing out your credit cards, it's a pretty good sign that you're going to start defaulting. So it's starting to giving you a bad grade, and that's where you get the lower scores, because you're maxing out the credit cards. It's not showing that you're playing with money. It's showing that you actually need the money, and then that can be scary for the credit card companies, because of more than likely people start defaulting after that. So you have to realize that is what they're looking at, but it doesn't mean that it's the end all for you not being able to purchase a home. It's not an excuse. The first thing you have to do is saying, okay, look, where's my credit and what can I do to boost it just enough to be able to qualify? Because sometimes that's all you need. You just need just enough score to get you to where you need to go. And then you can work on the rest of your habits, which is going to be, hey, I need to start looking at my spending. Why am I spending this on my credit card? Why am I putting, regular transactions on my credit card? And yes, some are good for your flight miles or points or what have you. But at the same time, it's counterproductive when you're paying, 30% interest on a lot of, these things. So that lunch that you just bought on a credit card is now costing you, 30% higher every single month because you just choose to carry the balance. Or you just didn't have an intention to pay it off that soon. And those are some of the myths that people run into, is that they think that they need a really high FICO score in order to make this happen, and it's just not true. But part of the FICO score myth is that if you have a good credit score, that you're going to be able to purchase a home, because they'll say, hey, can a relative help me buy a home? They have really good credit, but they don't have a job. No, because it's not just about having a good credit score, it's your ability to repay. Can you repay this? So just because you have a good credit score doesn't mean you're going to be able to pay the monthly balance that you need to take care of. So take a look at that. And if you haven't looked at your credit report, go get one of those free apps online and at least take a look at what's on there, and then get yourself clear on what you need to do in order to boost your score, in order to get you on the path to homeownership. Well, that's all I got for you guys today. Thanks for listening, and we'll see you on the next episode.